Screen two. Okay, I'm going to start sharing my screen. We'll go ahead and jump into it. All right, we'll go ahead and let people join. We're live now on Facebook and then YouTube. So I'll monitor anyone attending on the live side versus the Zoom if there's any questions there, but feel free to just type in the chat. And then of course you can unmute yourself if you want as well. But this is the first credit Q&A that we're doing in about, I want to say about a year. It might be about 10 months. So we did used to do these every month. We're going to start doing these again on a monthly basis. In most of them, I have some prepared remarks. Sometimes it's just full Q&A, just depending on how many questions there are pre-submitted. So if you're attending this one, you'll get updates and notifications for the next ones. And with that being said, we'll get going and just jump into everything we have for today. So my name is Ivory Becker. I own Incite Strategies, which is a full service credit repair company, and then also credit education platform called Creditworthy and a software called Credit Score Pro AI, which I co-founded with a business partner. So my background's everything credit related. I worked in regulatory compliance for a bit. I've been in lending all over the place where we touch credit scores. And really that's where my expertise is narrowed down is credit, how to understand credit. And we work with a lot of banks, lenders, realtors, anyone who needs to know about credit, how credit works, because I know there's a huge gap in that. If you're a new loan officer, there's not a lot of training on credit, and then you're expected to be that expert and able to explain that to your clients. And it's the same if you're in the banking industry or if you're a real estate agent. So the aim of these monthly sessions is really to help bridge that gap and hopefully help you answer those questions, especially if you're coming across specific scenarios that you don't know how to navigate. So before we dive into the questions, and my format for today, I suppose I should clarify, is I'm going to interweave those pre-submitted questions with some prepared topics. So some of that prepared topics is really just going to help answer those questions, and then just feel free, ask questions throughout. The more interactive this is, the more entertaining it is for everybody else, whether they're here live today or watching it later. So I like to start out with these first two graphics in a lot of the events that we do. I think it's nice information to know how many people are actually closing on a mortgage. So out of about 69,000 people who inquire, so they're talking to a lender and saying, hey, I'm interested in getting a mortgage, interested in buying a home, but I'm not sure if I'm going to do it or not. Only about 3 in 10 or 35% of those individuals actually end up closing on a mortgage. And I'm sorry, I'm missing that bottom number here on that graphic. I'll fix that for next time. But only about 35% close. And the main reason, or the main denial reason, when we look at actual denials, is credit history and debt to income ratio, which go hand in hand. Typically, if you have a lower credit score, your credit's been negatively impacted, you're paying more for borrowing money from those different lenders, which means you pay more for your debts, you have a higher debt to income ratio. This data, as you see on here, it shows is from 2020. So this is older data. This is data not from the type of environment we're in right now, which I like to highlight because you know what we're facing right now. Things are more expensive. Our budgets are really, really tight right now. We're in a different state than we were back in 2020. And consumer behavior is different as well. So let's look at that a bit before we go into the questions. I think it will set a good frame of mind for what our clients are seeing, what our borrowers are seeing, and how we can have good conversations with them that will help them get to the closing table. Okay, so like I said, consumer behavior is changing. We've got a lot of people who have the benefit of a solid interest rate from that 2.5%, 3.5%. I mean, even 4%, right? Those are all really great rates. They're staying put. If they can avoid having to buy a new home, they are. Younger borrowers are looking very different than prior generations as well. They're renting longer than they were before. And we'll look a little bit more into detail at that as well. And we're now starting to see lingering issues from COVID hardship. So a lot of the impact from COVID was delayed because of a lot of the assistance programs out there. A lot of people were able to float on things for a lot longer than they may have been able to previously. And we'll look at what that looks like in some of these statistics. Everything's more expensive. We all see that. Grocery store, gas, I mean, you name it, it costs more. Then an interesting statistic is the base monthly mortgage payment has increased by 78% since 2020. You know, some of that is interest rates, some of that's the appreciation of properties. Overall, everything costs a lot more. So if we look at our data from Q4 2023, and once I get the updated data in our next webinar, we'll have some new information. But looking at this data, what we see, if I were to summarize this slide, is we have credit card debt that's at higher levels. People are using their cards more, they're keeping the balance on those credit cards, and they're not paying it off. That's really a summary of what we're seeing on this slide. So gone are the days where we're seeing people pay off that credit card every single month, even though they're maxing it out. More and more people are using their cards to get by just for those normal day-to-day expenses. And before COVID, less than 50% of credit cards were active, and we're seeing a big change in that. On the Vantage score side, and actually in a little bit, we'll look at the differences between Vantage and FICO. If you are new in the loan officer role, that'll be really important for some of the conversations you're going to have with your clients. But the Vantage world breaks credit scores into 4 categories. So I have those here on the screen: subprime, near prime, prime, and super prime. You want your clients to be in the prime and super prime, right? It's a lot easier to do loans when they have higher credit scores. But what we're starting to see now with all this pressure on consumers is those people in that prime category of the scores between 661 and 780 are either dropping down to the near prime category or going up to the super prime. So we're starting to see this divergence in scores. And unfortunately, a lot of people are falling down into that near prime category. And those in near prime are moving down to subprime. Those in subprime are staying put. A lot of this could be the higher credit card balances, right? Having a high balance on your credit card, maxing those credit cards out is risk, right? So the credit score sees that risk and is going to lower the score accordingly. So some of it could be that, some of that could be the increase in delinquencies that we're seeing. Because when we look at that subprime tier, which is those from the 300 to 600 scores, at least on that Vantage side, we're seeing an increase of people going 30 days delinquent. And that's on auto loans, that's on mortgages, personal loans, and credit cards. And then when we look at, okay, we see more delinquencies, but what demographic of consumers are more delinquent? Most of it's falling in the Gen Z and the millennials. Gen X isn't too far behind the millennials. And then boomers are less delinquent than all other generations, but it's definitely a big difference or a big split between the Gen Z to the boomers. So essentially, Gen Z is twice as likely as their grandparents to be past due. That's important because most of the people who are probably staying put in their homes right now are going to be those boomers, are going to be those Gen X, and the people that are looking to buy are likely to be that millennial generation and then the up and coming Gen Zs as well. So we have a submitted question. How do old collections affect the credit score? So this slide is a bit about delinquency. I think what's important to know is the further delinquent someone is, the more it impacts the score. 30-day hit is worth less value than a 60-day hit on the credit report, for example. But when we're looking at the mortgage credit score, it's one of the oldest versions of the FICO credit score. So it's not time weighted. That means that a collection from 5 years ago is going to impact the credit score the same way as a collection from a year ago. They're both very bad. They're both detrimental for the score. If you're looking at someone who, let's say, had a high credit score, 780. Actually, we had one I had one I looked at yesterday. They're at 788. One new medical collection added to the credit report dropped their score to 680. That's a huge swing. That's a huge drop in score just from one single collection. So someone with a really spotless, solid credit profile, a collection can be worth 100 points or more. Somebody who, let's say, they have a lot of credit damage already, they have some late marks, they have some prior collections, there's some negative information on the report. If they get a new collection, they may see a drop that's only 25 points or maybe a bit more, but their credit score already says, hey, there's risk to lend to me. So it's not a surprise that there's a new collection. So the drop is less severe. It's more surprising for someone with a lack of negative history to get a new negative item. So they're going to see a more severe drop because it's meant to be a red flag. I think what's important to realize or to consider is that the credit score itself is not for the consumer, it's for the lenders, right? It's for the lenders to essentially judge the amount of risk they're taking on by letting someone borrow from them. So I think it's a bit of a perspective shift. Looking at all the impact on credit, it just has to do with what's helpful for a lender to know. So let's look at the next submitted question. How do you get rid of medical collections? So I like this question because there's been some changes with medical collections. If you are in, and I'll take a step back before I actually answer the question. If you are in the mortgage lending space, you may have been told, hey, you can ignore the medical collections. That may be true for getting an approval, but it still impacts the actual credit score. So removing a collection from the credit report can be helpful, right? It's going to improve the credit score. You just got rid of negative information. So medical collections are unique in that from a recent law passed, once that collection is paid, it's automatically going to be removed from the credit report by the credit bureaus. So the bureaus have put an agreement that they're going to remove all paid medical collections from the credit report. So while underwriting can ignore it, if you have your client pay that collection, whether they want to settle, I always recommend settling, it's automatically going to be removed from the credit report and they're going to see a benefit from the increase of their score. So the simple answer of how do you get rid of it is you can pay it. They can also, if they don't recognize it, if they have sufficient time, I do always recommend disputing it, making sure it is a valid collection, making sure it's something that they actually owe, making sure it's not too old to be on their credit report. There's a whole bunch to look into, but there's two ways, essentially disputing it and getting it removed because of whatever issue is identified, or by paying it, and then it will automatically be removed from the credit report. And if you did just join, I know we got some on the live on YouTube as well as Facebook. And then if you're here in the Zoom, you can always unmute yourself, ask questions, or just type in the chat. Whatever is fine. So I mentioned earlier how I was going to talk about the differences in credit scores. So we have the FICO credit score, which is the score that's been standardized and is used in lending for 90% of lending decisions. And then in 2006, we had the creation of the Vantage credit score. So what's interesting is Equifax, Experian, and TransUnion, so the big three that give you your credit scores, do not actually own FICO, right? They don't own this algorithm. Fair Isaac Corporation, now known as FICO, created that algorithm and allows the bureaus to use it. Well, the bureaus didn't like that they don't own it. So they created their own model, which is that Vantage score model. And so they combined together, created it. Now that model is used in places like Credit Karma, right? So I'm sure you've had a client tell you that their credit score is 680, and then you pull their FICO credit score and it's not 680. We'll put it that way. It's a lot lower than 680. So if you look at these two score models on the screen, you're going to see there's a difference in the way it's looking at information. So payment history, the percentage of the weighting of that calculation of the score is different. Utilization is different, right? There are differences in those factors. So those scores will never match. They'll never be a one-to-one. So I think one of the best things you can explain to your client is, well, the Vantage score isn't wrong. The score you see on Credit Karma, it isn't wrong. It's just a different type of credit score. And in mortgage lending, we just don't use that credit score. And I think this is a good lead into the next question that was submitted, which is, why is the mortgage credit score so different? So we answered part of it, but what if your client's going to Experian.com or TransUnion.com or Equifax.com and pulling their credit scores? Are they going to see the credit score that you see as a mortgage lender, that you see if you're if they want a business loan or a car loan, etc.? So on the screen, it's very obvious. There's a whole bunch of different credit scores here. We've got FICO score 8, score 5, bank card score 5, mortgage score 2. FICO score 9 is showing as the newly released version. Since this graphic was created, there's actually score 10 and 10T. 9 really never took off. No one really uses it. But think of these credit scores, all these these different versions as like different models of iPhones. We started with the first generation, and then we got generation 2, which was supposed to be better than the prior generation, and so on and so forth. So now we're at generation 10, right? The whole point of coming up with a new model is it's meant to interpret that information better. It's meant to be a better predictor of risk. So some differences that I think are beneficial. If you're in the mortgage lending space, I'd mentioned earlier that the mortgage scores aren't time weighted. This means a late mark from 2 years ago is just as impactful as a late mark from 5 years ago. Whereas with some of these newer models like FICO score 8 or 9, it's time weighted. So after 2 years, that negative information becomes less impactful. These are reasons why the credit scores on FICO 8 versus what you're pulling in mortgage lending are going to be different, right? And if you are on the banking side, the auto loans and the credit cards zero in on scores even more. And I think the best way to look at it is the auto score cares more about loans that are like auto loans and hyper focuses on consumer behavior there, where with credit cards, it cares more about revolving accounts. So that goes back to the question most of your clients will ask is, well, which credit score is the right score? They all are. They're just never going to be exactly the same. If you have someone that has a perfect credit score on FICO 8, they may not have that perfect credit score on FICO 5 or 4 or 9. It's just going to vary a little bit based on the way that information is utilized in the algorithm. So credit scoring on the surface, very simple. As you dive deep, it can get more complex, but hopefully that gives you some sort of insight that can help you with answering those questions with your clients. And again, if you joined, feel free to unmute, ask questions. The more interactive, the better. I feel like it makes it more enjoyable for everyone, whether they're here now or watching later. Or you can use the chat. But I will keep going through the pre-submitted questions as well. Okay. So some basic conversations about score impact. So I thought it'd be helpful to put some quick hit tips on the screen. This is just good information for any person that's coming to apply to you for any kind of loan, credit card, etc., to help their score be as high as possible in the simplest way. So you want to make sure they have an open and active credit card that has been used at least once in the last 6 months, ideally the last 3 months. The reason why that's important is inactive accounts are not factored into your credit score. It's really, really important. So if they have a credit card, I think an awesome example where we all see it is if you have a retail credit card. Let's say you got a retail credit card, it's for Lowe's or Home Depot. You use it maybe once a year. When a card isn't deemed as active, that data, the algorithm doesn't see it as good data, right? There's no reliable data that it can use to determine your likelihood to be able to pay things on time. So it's just excluded. It's ignored in the credit score algorithm. So if you have a client who said, hey, I was getting ready to buy a house, and so I made sure I paid all my debts off 6 months ago. I paid all my credit cards off, and I haven't used them at all. Well, that might actually be suppressing their score, not suppressing it, but keeping their score down, where all they need to do is just make a purchase, make sure a statement is cycled and paid off, and then that card is now active and it's going to help their credit score. Utilization is 30% of the credit score. So if that credit card is not active, they're missing out on that 30% from the utilization ratio. They're missing out on the payment history factor. There's so much more than that even that they're missing out on. So those credit cards can help about 90% of what makes up their credit score. Not paying off loans right before applying for any sort of debt. So a lot of times I have clients that will say, well, I paid my car loan off because I didn't want to have that debt on there. I didn't want it to affect my debt to income ratio. Fair assumption, right? We don't want excessive debt. We don't want anything to adversely impact the ability to qualify. In many cases, it may be best just to pay it off as part of closing because, and I don't have it showing on here, unfortunately, the algorithm's kind of hidden in the background there, but let's just go back to this picture. If we look at payment history, we look at length of credit and credit mix. If I close that car loan, I'm affecting these three categories. Because remember, only open and active accounts are going to affect the algorithm. So if that car loan, let's say I had a 5-year car loan or 7-year car loan, and I just paid it off, I lost that length because the credit score algorithm is going to average out the length of my open credit accounts. So if it shortens my credit profile, my score is going to drop. And so you may see a big drop in credit score from closing out accounts. You can avoid that, like I was saying, by just paying it off as part of closing, so you can still exclude it from the debt to income ratio that way. Authorized user accounts for limited credit profiles. If someone has limited credit history, becoming an authorized user will allow them to inherit the history of that person they're authorized on. So that can be really helpful. I will say this is really only going to be a temporary solution. By the end of 2025, there's going to be a new credit score algorithm that's used in mortgage lending, and we will talk about that in one of these Q&As here in the future. And that's not going to be an option anymore. We'll just put it that way. So it's just best if people open their own credit cards, but for now, it's a good hack. Utilizing credit building tools. So there's a lot of tools that can allow your clients to add good information on their credit reports that can help in creating a score. Not all of it affects the algorithm right now. Next year, when we see that change, that's going to be a game changer. So even though we won't be able to use authorized user accounts, we're going to be able to switch it for a lot of these credit building tools. And then resolving errors on the credit report. When it comes to credit reports, there's a lot of errors that exist. Those errors can be utilized to get rid of negative information on the report. So whether it's incorrect, mismatching, or obsolete information that's too old, that can all help. Okay, so we have this submitted question. Once all debt is paid off, how long does it take for the credit score to be a better score after the debt's paid off? I think we answered some of that. It depends on what you're paying off, right? If we're paying off and closing accounts, then that will adversely impact the average age of open accounts, and we could see a big drop in score. But otherwise, it just has to do with when the creditor sends information to the credit bureaus, because that's what will update the credit report. So each creditor reports once per month. It's not going to be the same for every single creditor. You can see this information on the credit report. It will show on the credit report. And then your client typically needs to make sure the accounts are paid down. I'm assuming this will be credit cards. The credit cards are paid down about 3 to 4 days, ideally, before the statements are created, which they can see on their monthly credit card statement. And then the next time that they report, it will all show up on there. So usually about 30 days, 30 to 45 days. If your timing's horrible, it could be 60 days, but ideally 30 to 45 days. And I thought this would be good to add. This is a total diversion from any of the submitted questions, but do you ever look at this section on your credit report, on your client's credit report, excuse me? this can be a nice key into understanding what's pulling their scores down. So this section, usually it's on the first page or two of the credit report, is going to show you the reasons. These are literal reason codes as to what's impacting the credit scores. It's your key to what's going on. So if the length of time since accounts have been established is an issue, we talked about one of the solutions being authorized user. Do they have a family member that has longevity on a credit account that could be added? All of a sudden, this reason code is no longer an issue. We're going to see a score increase. Level of delinquency on accounts. Is there an opportunity to get negative accounts removed? Obviously, that would be the solution there. Too many accounts with balances. Well, that's looking at credit cards. I think something important to understand that I probably should have mentioned earlier, but there's so much to talk about. Sorry. Hopefully your eyes aren't hurting from me switching slides so much. This utilization, 30% of the credit score, looking at your balance versus your credit limit, that's focused on credit cards. That's not focused on loans. So paying off a loan isn't going to help the credit score from utilization, right? Only paying down the credit cards is going to help in this category. So, go back where I was. So if they're paying down credit cards, where did it go? Too many accounts with balances, paying down their credit card balances, that's going to help their scores. Does anyone know how you would recommend someone to pay down their credit cards for a credit score boost? Anyone know the answer there? You can type in the chat if you want. If you're not sure, 30%. Okay. So paying down to 30%. Yes, that is part of it. What I would recommend, less than 10%. Okay. Now, what about the strategy? How should I go about paying? Let's say I have 3 credit cards that are all maxed out. One's $500, one's $2,000, the other's, I don't know, $700. How should I go about paying them? Higher utilization first? What if they're all maxed? Okay. So you want to go off the lowest credit limit first, as far as the maxed out cards go, because it's all about ratios. So the $500 credit card and the $5,000 credit card maxed both impact the score the same. They're both 100% utilization. So the way the credit score algorithm is going to calculate the impact of the scores, each card individually, and then overall utilization on the report as a whole. So it's 2 different calculations. It's a lot easier, of course, to pay down the $500 credit card first, then go after the $700, and then go after the $5,000. Because you're going to see jumps in the score faster that way. Another option that's a little outside of the box is if their scores are high enough, this is very happy balance to get there, but if their scores are high enough, moving, let's say they pay down the $500 card, the $700 card, and they're like, look, this $5,000 card, that's a hard one for me. Moving that to a personal loan, that's going to allow them to see a big jump in their score because their utilization is only impacted by those credit cards, right? So a loan that was $5,000 and is slowly being paid down isn't adversely going to impact the score. So it has to be the right scenario for that to make sense. Good examples are if you have someone trying to get a home equity line of credit to pay off debt, that can be the in-between solution. It's the path to get them to the approval so they can get a high enough score to qualify. Okay, I went on a side tangent. Let's see. Anyway, this section is very helpful to you if you are a mortgage loan officer. It does give you a key or a legend as far as what's going on. And then this is an interesting one. So you may have someone that's credit score, you pull a credit report, there's items on their credit report, but you still see no credit scores. And it may this one's the right one. No scored recent account information. So let's say they have open credit cards on their credit report. You can't understand why they're not getting a credit score. It's that scenario where they haven't used the accounts. So they're stale, they're inactive. So that can be a quick and easy solution. Hey, all I need you to do is use use your credit cards and just wait for the statement to be produced, and then you'll have a score again. So simple solution. Or they have no credit. I think that's an obvious one. They need to build credit, but that's the obvious. So next submitted question was, when should a client use a rapid rescore? So the rapid rescore is what the mortgage lender can use to quickly update the credit report, specifically the lender credit report with the 3 credit bureaus. So that's the key. It impacts the lender's credit report. So the best times to use that is when the client recently paid down a big portion of their credit card debt, then the rapid rescore is going to update that information sooner, right? Instead of waiting for that whole cycle to happen, it's just going to update those balances sooner. If negative information has been removed from the credit report, or like, let's say they have a letter from the creditor specifically saying, we will remove this. It may take up to 30 to 60 days to see it. That may be a good scenario where, as long as your report provider is talking directly with that creditor and they're forcing that update sooner, a rapid rescore could make sense there. But that's typically when it's going to be used, is really it's just to make information show up quicker on the lender's credit report so you can move forward with those score changes. Okay. So what about clients whose credit scores don't quite cut it even with the credit advice? So this is a nice big data heavy slide that I tried to make as pretty as possible. So bear with me here. So what we see if we look at mortgage loans originated in 2023, that's the giant number at the top. 40% of the people who got the loans had credit scores over 760. So 62% of people who got loans, 40% of them had scores over 760. And as you go down, you see the lower the credit score, the less likely you are to get a loan. So going from near prime to prime doubles the likelihood, right? So the whole point, if we take apart this slide, is basically to say higher scores get people credit scores, get people loans, right? I think it's obvious. What we do in our space is we help people jump up to these different buckets to get them to that point where they can qualify. So on average, if someone's in that 620 to 659 range, to get to the 660 to 719, it's about 3 months, 4 months to go from under 620. So that's usually going to be the people, the 400, well, 350s and above to get to the 620 plus. And then for people in the higher ranges, that 720 to 759, to get over 760, it takes about 5 months. So they do take longer to get the higher scores. There's a lot less going on, a lot less issues to get people there. So what exactly do we do to do that? Our whole process is looking at all those aspects of that credit report. So when you look at your lender report and you're trying to dissect, well, what's causing the score to go down or what's keeping the score from going up? That's really where we come into play, is to analyzing all of those situations and determining what are the quick solutions and what are the solutions that are available that may take a little bit of time. So I think the best way to look at it is, how do we optimize the good things and how do we fill in the gaps where there is nothing positively affecting the credit score? And then how do we get rid of derogatory information from the credit score? The derogatory side is the credit repair side. That's the part where you're looking at, is the information on the report compliant with the laws and regulations on credit reporting? It's never about, was someone past due? Did they owe that original creditor that was sold to a collection agency? So, for example, if you're looking at a credit report, and from our perspective, we're looking at mismatching information on the credit bureaus. Is one credit bureau showing that the client was past due in August, and then the other 2 bureaus say September? That's an issue with reporting. So legally, the credit bureaus they all have to match. It all has to be accurate. So if there's any inconsistencies across the 3 reports, it's inaccurate. And that is what allows a consumer to dispute the information if they want themselves, or to hire someone to do it for them. Other things that we tend to see is marked past due on that final payment. Let's say they paid off their auto loan and the last month they were marked past due, or there was a mortgage servicer change and they get marked past due. With collection accounts, we often see a lack of documentation. Maybe a third-party collection agency is trying to collect a debt, but they have no documents from that original creditor showing that that client owed that debt in the first place. Client very well may have owed the debt, but that collection agency has to have documentation, right? So if you were to work with us on the credit repair side, we're looking at how do we help with debt to income ratio? How do we save as much money as possible to get them to that loan closing? And then we want to remove as much as possible by finding those compliance issues. So ideally, we pay the things that need to be paid as efficiently as possible to get the biggest, I guess, like the biggest bang for your buck is what the normal phrase is, but the biggest benefit to the score without spending as little money as possible, right? We don't want to spend a lot of money on it. We want that money for the mortgage process or whatever loan they're trying to get. And then how do we identify opportunities for credit score boosts based on what's not on the report? So that's really looking at, okay, how does that mortgage credit score algorithm function differently than other credit score algorithms, and how can we see score boosts there, right? And then how do we get more points out of the good accounts that are there? And then the rest is credit education, teaching those clients, here's the things you want to pay, here's the things you want to ignore, here's the behaviors that you should have in place to keep your scores high and maintain it. Okay, so I thought I would share a little bit of success stories just to give you an idea of what true credit repair actually does. So we had a client starting 500, 514, 518, 473. She had student loan collections, a couple of normal collections, third-party collections, and then a lack of credit history. I think she had one open account, if I recall properly. So by the end of the process, she was at 741, 714, and 681. Big difference on the 681 there is one of those new accounts just wasn't showing up yet. I had mentioned how much one collection can impact the scores at the beginning. So this client came to us at 713, 712, and 712 again. And that one collection dropped his score. So we got it off in about 30 days, and that put him back to the mid sevens, so 764 range. And then we had another client, similar scenario, again, one single collection. She was at almost perfect scores, so 799, 793, and 781 is where we got her back to. And then that collection had dropped her scores to 630, 640, and 700. So it can be pretty crazy. The last one's 39 collections. And those were all medical collections, 39 medical collections. And once we got those removed, she was able to buy her home and her scores were in the 700s. I'm not sure why I didn't put the scores there. So what's important nowadays is I think more of the clients we're seeing, like we talked in the beginning about the delinquencies and the pressure consumers are having right now. If you can give them credit advice or give them credit resources, help them get to the point where their scores are higher, they're going to stick with you. Unfortunately, we're in a time where there's less loans and more people trying to give the loans. So anything that can set you apart from your peers is really, really, really imperative. Now, there are ways to where you can help your clients with improving their scores. One, by being able to read this section and identify those options and those opportunities. And we do these types of events. I have one every other Thursday, and then we'll do these Q&As once a month. I know we don't have too many people on today. Hopefully we get some more participation so it can be a true Q&A next time instead of me just reading the submitted questions. But that'll help you with being able to more quickly identify what's going on with someone's credit report, the more educational sessions you attend, of course. But our other option is we do have a software that your clients can use. You can use it too, but I just recommend you don't need something else on your plate. You're already trying to run a business, but your clients can utilize the AI software that we have that will read the credit report. So it's a bit different than the what if simulators, the Wayfinder, the things you use with Credit Expert, because it's looking at those aspects of more than, well, what can I do for a rapid rescore? You know, what if I pay this off? It's a lot more than that. It's looking at what's not on the credit report. What can we add to the credit report to boost scores? What opportunities exist for disputing based on errors that are identified? And it has the credit education in there. So it's really an all-in-one. It allows your clients to dispute the information on their report by finding those compliance issues, tells them exactly how to improve their scores for what's not on their report and how to get more points out of the things that is on their report. So that is a software we have available to them. The good thing about it is the only thing they pay for is their credit report. So the software itself is free. So Renee, I know you already work with us. We use this with any of your clients. So we give them this option too. So essentially what happens is the AI, when someone signs up, they set up their credit monitoring through our partner, Smart Credit. The AI is going to analyze their credit report. It reads the raw data. So this part's interesting. This is what you don't see on the right hand of the screen. That's what you don't see on the credit report. Your oh, why am I blanking on the word I want to use? Your vendor. Your vendor gives you a pretty credit report. This is like a smart credit report, but your vendor is going to make the file pretty. There's way more information on the back end than what we'll ever see on the vendor side of the report. And the AI is reading that raw data to find all of those errors, right? And then it just creates a dispute. So the client clicks what accounts they want to dispute. They're going to choose the negative accounts. The AI is going to determine the most appropriate dispute. It's really, really good and really accurate. It's going to find things we can't find just by looking at the credit report. Even a credit expert like me, unless I'm scouring the raw data, it's going to find things on the back end that I won't see. And then the only time we suggest like a client deviating from the reason AI creates is for identity theft. AI doesn't know what identity theft is, right? So they would just pick the drop down and change it to identity theft if that's the case. And then I do recommend they actually print and send the disputes. But yeah, it's literally that simple. They click save, and then the AI makes the whole dispute letter for them. They can print it and send it, or they can use our integration with mail-.io, which will mail it for them. It is better if they print it themselves, but some people don't have printers anymore. So that's completely fine. Then the AI is looking at all those other factors, right? Of how can I improve the credit score? So where are they not impacting the algorithm? What are their goals? Because remember, how many score algorithms exist? A lot. We saw that in the beginning. So if they pick their goals to buy a house, the AI is then analyzing the report for the score algorithm used in mortgage lending, right? So that's the importance of this part. They pick buy a home, mortgage lending, FICO is used. And then it creates an action plan for them based on the mortgage FICO says, oh, this credit card's stale, you haven't used it, you need to use it. Or you need to open this account, or you need to pay this account down by this much. And as they complete each action, it will tell them, you completed this, here's the next most important step. And then every month it's renewed, it's sent to them. And the same with the dispute side. Every time there's a new credit report available, which is monthly, it will automatically reanalyze and create the disputes. And it gives them those credit building tools that are going to help them improve their scores too. And it has financial literacy. So we have a whole course in there about why credit matters, how to understand the different algorithms. We do have lenders that use this just for the course side or for their own credit too, just to see what's causing scores to go up and down. But this is really to make sure that anyone who's using it can really pair the why behind what's happening on their report, the why with the action plan. Why is the AI telling me I need to take these actions? And then there's videos corresponding. So if you utilize this with your clients, it really just allows you to not have to be the expert. You can just be know enough to be dangerous, if you will. And you can, if you want to know a lot more, dive into, of course, all of our events, so the once a month Q&A, and then the weekly, we do every other week for loan officers on Thursdays and the opposing week for your clients. But you can attend both. We have a lot of people that do. And then this really leads into the submitted question. Are there any classes or groups to help improve consumer credit? Yeah. So every other Thursday, we do that for any consumer who wants. We have a different topic that we go over every other week. Some are on collection, some are on just generally what credit is. Next week, actually, or this Thursday is just focused on credit cards. Just how to pay down debt the most effective way for credit scores. So yes, we do have different events there. And if you attended this or registered, even if you're not here today, you'll get links to that as well. And then outside of that, I guess the only thing I would say is we have the two structures. We have the software where clients can do everything themselves. And then we have the option where they have the assistance from us and it's scaled at different levels. And then of course we're here for you on the professional side. If you want to go over scenarios that you have, you can do it in this open forum or you can email me privately. So my email is right here on the left-hand side. If you're interested in being an affiliate where you just give the Credit Score Pro link to your clients and you can track their progress, you can have that too. It's completely free to you. Your client pays $39 a month for their credit report. The software is free to them. Or, you can always send the scenarios to us directly. We'll walk your client through the different options. Some we're going to say, hey, using the software makes the most sense. You don't necessarily need us. And some we're going to say, this needs a little bit more elbow grease. It's probably best to use our full service model where we're looking through things. Identity theft. Yeah. Identity theft is a big one. Sorry, I didn't see your question right away, Renee. Yeah, identity theft is huge. With certain identity theft scenarios, we're likely to get our attorney partnership involved as well, which is a huge benefit to the client. There's the potential for monetary compensation for certain violations there on the identity theft space, especially if their creditors are failing to work with them when they've notified them of the identity theft. Same with the credit bureaus. A lot of what we do is around those laws and regulations, just as much as it is around how the algorithm itself functions. So in some situations, it may make sense for us to take up a case with their creditors, with the bureaus, whether it's arbitration or litigation, and it can get them across the finish line for fixing their credit as a whole. I will say if their plans to get us home as quickly as possible, a lot of times it's let's get your score up to where you need to be just to get to that finish line. And then we're going to clean up everything with arbitration or litigation later from the identity theft. It just kind of depends on their timeline. Because going down
that's where we're at, because he's fine to proceed with the loan with a score as is.
Mm-hmm.
And I can even get a credit supplement showing that these accounts are not his, but I didn't know what to do with him after that. I was like,
yeah,
I can't help you get it all. So I'll definitely send him away.
Yeah, send them our way. And what we'll probably do is wait. We can do some things now and we'll wait for other things until after the loan's done. Because I don't want to, we're not going to do anything to impact the loan in process.
Yeah.
So yeah, I think that's the best case scenario there. Well, hopefully this was a little bit insightful. I know we didn't have as many people join today as registered, but it is now June and turning into July. So all the nice summer weather is upon us. But we will start doing these monthly again. I hope to get back to that point where we're at the 200-300 people that used to show up. But we'll build our way back. So I don't know. Does anyone else have any questions? Lewis, and I'll look and see let me stop sharing my screen. I'll look and see on Facebook if we have anything. Nothing on there. Okay, well with that concludes today.
Do you get a notification since we registered? Will you send out like reminders when you have? Okay.
Yeah, I'll send out the reminders too. And then I'll send everyone a link to the email or the events on Thursdays. most of those, they're posted through August right now. And they're going to be different topics than what we do in the Q&A side. A lot of it's focused on the AI too. So it's just a little bit different than the straight Incite strategies. But also, if you have specific topics you want me to cover, I'm happy to do webinars on that too. So, cool. All right. Thank you, everyone.